Broadcom is one of the most important companies in the entire AI boom, and it just dropped about 20% from its high after earnings. So everyone's asking, do I finally buy the dip or did I miss it? Here's what the big stock channels say. Just buy Broadcom at this price, but I'll show you a smarter way to own the same company. One trade that pays me to own Broadcom even cheaper than today's already lower price. And this trade wins whether Broadcom goes up or down. These are the exact trades I send to my members in real time. I'll show you the real fill straight from my brokerage. No predictions, no price targets. I don't think anyone can reliably call where Broad goes next. But what I can do is structure a trade that pays me to enter and wins in more than one direction. Because my whole job is to teach you to win when you're right, win when you're wrong, and never gamble. And stay till the very end. I'll show you the fully defined risk version, and even if you've never traded an option before in your entire life, you'll understand exactly why this trade works and why it's better than buying the stock at the current market price. Here you can see the trade. We'll discuss this more later in the video. I got paid $65 just to open it. Here's exactly what you're getting. The exact Broadcom trade, a real fill, and we got paid to open the trade. You'll win whether it goes up or down. And at the end of this video, the defined risk version, plus the price I'd love to own Broadcom at. First, why Broadcom? Because it's one of the backbones of the AI build-out. The chips and the infrastructure are a huge chunk of what AI runs on. And while Broadcom has already run a long way, the question everyone has is, should we chase it here and buy, or should we wait? My answer isn't a prediction, it's a structure, and it's also your edge that you can apply to every single one of your trades in the future. Why I'm not just buying the shares. If I just buy the shares, I only win if the stock goes up, and I'm paying the full price today. Instead, I want to participate in the upside, get paid to wait, and have a plan if it drops. That's exactly what this option structure does. Never traded options before? Here's the whole idea in 20 seconds. Selling a put just means I agree to buy Broadcom at a lower price, and I get paid cash today for agreeing to do so. It's exactly like placing a buy it on sale order below today's price, except you get paid to place it. If the stock never drops to my price, I get to keep the cash. If it does drop, I own one of the best companies in the world on sale. That's the edge. You get paid to be patient instead of paying full price and just hoping that it goes up. The setup, my finance bull trade on Broadcom, I got paid. The bet, we buy a 430 call. We sell a 490 call. This is a call debit spread that gives us $60 per share of upside participation. The financing, we sold 2 of the $330 puts only because I'd love to own Broadcom at $330, which would represent a steep discount from its current market price. The result, we opened this trade for a credit. I got paid $65 just to put this trade on. Most people pay to buy a call option, but I got paid to place mine. It's like walking into a casino and the casino pays you to sit down at the table. If Broadcom goes up, my call spread profits, and I keep that opening credit no matter what happens. Here's the actual order, straight from my brokerage. Look at the top, it filled for a credit. I got paid $65 just to put this Broadcom trade on. Here you can see I got paid $65 to enter, and this specific trade has $6,000 of potential upside if Broadcom trades above $490 a share. And you don't just have to trade this as a one lot. If you want to trade 5 of these, then you have $30,000 of potential upside while also getting paid to enter the trade. Remember, stay till the end and I'll show you how to run this with defined risk, plus the exact discount I'd love to buy Broadcom at. But first, let me show you why this trade wins in more than one direction. This is not a defined risk trade. Those 2 puts are naked. I want you to know that. I sell them on purpose, but only at a price where I'd be thrilled to own Broadcom. Are you nervous about that? Stay until the end. I'll show you the defined risk version. This trade is still open, so here's the results so far. I just opened the trade, so the result right now is simple. I was paid $65 to enter this trade. From here, it wins in more than one direction. Let me show you all three scenarios. How this wins, up, down, or sideways. If Broadcom goes up, the 430 by 490 call spread profits, and I keep the credit. So I got paid to open the trade, and my maximum profit is $6,000 if Broadcom trades above 490. If Broadcom falls to 330, I get assigned Broadcom at a steep discount. Remember, people are buying Broadcom at the market price, and people have purchased and owned Broadcom close to $500 a share. Owning it at $330 is an enormous discount from where many other people have purchased. Plus, I get to keep the initial gift, which is the credit that I received when I opened up the trade. If Broadcom just trades sideways, I still get to keep the initial credit. However, if you decide to not use this structure and buy the shares in the open market, then being long the stock, you can only win in one direction, and that's if the stock goes up. Do you want to actually own Broadcom? If it falls to my strike price, I do own it, cheaper than today, and I keep the full credit when I open the trade. Worried that you'll miss a big AI run? My call spread profits as Broadcom rises up to its cap, and I was paid to take the position. The only thing I give up are gains above that cap. So if Broadcom trades above 490, for a company this good, a discount plus getting paid beats paying full price and hoping that the stock will go up. Why getting paid to enter is your whole edge. Most traders pay a debit to buy a call option, so they need to be right on the direction and the timing. I opened this trade for a credit, so time passing and a flat market, they both work for me. I don't need to predict, I just need the right structure. That's your entire edge, and that's your advantage. Quick, don't go anywhere. The defined risk version I promised you is about 90 seconds away. The exact same idea with strictly limited risk. But first, the one mistake that ruins this trade for most beginners, and it's not what you think. The number one mistake that ruins this trade. This only works if you genuinely want to own the stock at the put strike. Selling puts on a company you don't want to own equals gambling for premium. The discipline is the edge. Pick the company first, then pick your strike price second. Is this too good to be true? The honest risk. Real talk. The risk is Broadcom craters far below 330. Then you own it lower than you wanted to. A real loss, not a bargain. That's why I only sell puts on companies I'd be happy to hold for years. No trade is risk-free. This one just pays me to take a risk that I already wanted. Here's the proof. This is the real account that these trades come from. As you can see, we beat the market during a bull and a bear market. During March 2026, when the stock market was down around 7%, we were down less than 1%. Here's the real lesson. I'm not predicting Broadcom. Instead, I structured a trade that wins more than one way. Up, down, or sideways, I was simply paid to participate. With this structure, you win when you're right, you win when you're wrong, and you never gamble. Okay, here's what I promised. First, if selling naked puts makes you nervous, you can turn this into a fully defined risk trade. Instead of just selling the put, you can sell one put and you can buy a lower price put. Now your downside is capped. You give up a little bit of premium, but you know your exact maximum risk. For example, instead of just agreeing to buy Broadcom at $330, you can agree to buy Broadcom at $350, and then you can buy a put option with a strike price of $300 to cap your risk. That way, your defined risk is only $50 per share. Second, I sold the 330 puts because that's the price where I'd be thrilled to own Broadcom, a steep discount from where it trades today. If it falls there and I'm assigned, I'm not upset. I'm getting one of the best companies in the world on sale. That's the whole mindset. Only sell puts on companies you'd be lucky to own cheaper. Who's telling you this? I'm a former Wall Street investment banker, Ivy League graduate. And every trade I show is real and verified. That's the exact trade I send to my members in real time, and you can get them too. There's a 14-day trial. Link is in the description. Even if you've never traded options before, start there. Want to see my actual results? Watch this next. I show my actual trading statements. Click on the card right now to watch that video. That's the trade. Pay to enter a winner, whether Broadcom goes up or down, and a structure you can run on almost any great company. If you want every trade I make in real time, the link is below. And tell me in the comments which stock I should do this on next. Your comment and your stock pick could be our next video. Win when you're right, win when you're wrong, never gamble. See you in the next one.